Do you know what shares are? Investing in stocks is actually one of the strongest ways to amass long-term wealth. Many people, however, still perceive the stock market as overly complicated. In today's video, we're addressing this misconception and focusing on the basics of shares. This will be part of a comprehensive series of approximately 20 videos that I will be creating here on YouTube, all starting with the fundamentals of shares. Even investment in practice. And if you haven't seen the other early videos on the channel, I highly recommend that you see them, because they are the foundation of a financial mindset. So if you are very new to this, very new to the finance part, watch the basics first and then come to this comprehensive course that provides thorough insights into advanced topics. It's going to be pretty thorough. So here you're going to learn what stocks are and how they work, because companies issue stocks. How could that potentially impact you? Understanding the organization of the stock market includes some interesting trivia about major corporations and their key shareholders. For aspiring investors, this video serves as the perfect introductory guide. Let's begin with a fundamental inquiry. What are stocks? Essentially, shares represent partial ownership in a company. By purchasing stock, you're acquiring a small portion of that business. Becoming a partner in the company, even if it's very little, very small. But yes, you're officially a partner in the firm. You officially own part of the company. So officially, you are one of the owners of that company. So to illustrate, think of a bakery. Imagine that it belongs to a single owner. And this owner one day decides to expand the bakery, and he thinks like, oh, I'm going to split the business into 1,000 equal parts. And these equal parts are what we call shares. And each piece, that is each share, represents a part of the company. And he who buys a piece or several pieces will also own that business to the extent of the shares he bought. So if a person buys, for example, 50% of all the shares of the bakery, for example, they are buying 50% of the business. If she buys, for example, 80%, she can even. It's to control the business. And the big balcony lies in buying shares of good companies and earning from their growth. Because I imagine if you had bought Amazon stock when the business was right in the beginning, today you would basically be rich, you know? Stocks were pretty cheap, weren't they? Right at the beginning of the business. But there's also a business. When you're at your start, stocks are going to be cheap. And it's not a business either. Stabilized, so people are going to be a little afraid to buy those stocks. So going back to the good side of buying shares, you can gain from the valuation of the company, for example, Amazon, Tesla, which started there with a more experimental business and then grew in value. And the company's shares will also be valued by what the company values itself. And then there's the dividend part. What would that share of dividends be? Some companies, in addition to, if they appreciate and you can sell that stock for a better price or keep it, then your equity will grow with that appreciation. Some companies even distribute part of their profits to shareholders. Imagine that the bakery we were talking about before, you bought 50% of its shares and it is making a lot of profit. Let's say that the management of the business sees that it has no right place to invest. Amount of money that comes from the profit of the business, and then the management decides to take that money and divide it to the shareholders. Then you take him 50% of that amount that was divided, which are the dividends. And it also has a bad side. If the company goes bankrupt, you basically go along. If the company depreciates, you also lose equity. It's basically pretty simple. When you buy stock, you buy part of the business, you're part of that business now, so if it's going well, are you okay too? But if he goes badly, you go badly too. Unless you sell the papers, the shares, before they are priced very badly. So now that you understand what stocks are, they are parts of a business. Now let's try to understand how they reach investors, share buyers. So when a company needs money to do anything, an investment in the production line, expand the business overall, IPO, the initial public offering. So imagine that the owner of the bakery, thought like this: look, I can expand my business and stay here, the largest bakery in the state, for example. So I need to have money, I need investors to increase, for example, production, improve the process. He makes an IPO of the business, and basically he does what we said before. He will take the business and divide it into equal parts. And you're gonna put that in an initial public offering. After going to the stock market in an initial public offering, in an IPO, there will be the first investors who will buy those shares and will also be part of the business. But then you ask yourself, why would a company do this? Businesses do this basically to raise money to expand their business. And it's a way to do that without creating debt, which is basically what it is. Imagine that a company needs $1,000 to expand production line, expand business. In general, instead of her going to the bank and taking out the loan and paying interest, which are high, she prefers to go to the stock market. And so she can raise the investment she needs without having created a debt. And then, imagine, you may be wondering, but is this such a thing? New news? No. Stock market is already a very old thing and started in Holland in the 17th century with the company East India Company, which was a company. It's just that I worked with shipping. So this company needed to raise money to continue the operation, to expand the operation. That's basically how the stock market, or also, as people say, the stock exchange began. And how does this initial public offering, this IPO, work? Basically, the company defines the value of the business. The owner of the bakery, who is our example, will look at the business and will try to arrive at a real value for that business. How much is it worth? It has the brand, it has the machinery, it has everything there that has already been invested. When it reaches that value, it will decide how many shares it will issue. It can be 1,000, it can be 1,000, it can be 100 shares, and it will also set an initial value for each share because it also needs to have the money to be reinvested. So after that, he will launch these shares on the market and investors decide whether they want to buy or not, and after the IPO happens the next. As you now, if you bought the stock, are the owner of part of that company, only you can negotiate that part that is yours. As if you had 11 cars, for example. Only you, as the owner, can negotiate that car. So, after this initial part that is OIPO, the shares will start running freely. So, for example, let's say I own Tesla stock and you're interested in buying Tesla stock. Can I freely sell this? The shares for you through the stock market, Tesla doesn't have much contact with that anymore. I sell part of my business officially on the stock market to you. And now imagine that you are entering an old market in which you have to negotiate the price of things all the time. The stock market used to be like that. Only today it works more virtually. Buying and selling prices are determined by the investors themselves. More technically speaking, it's going to be the supply and demand of stocks. Many people want to buy a stock, the price of that stock tends to go up, and when no one else wants to buy, the price of that stock tends to go down. Think like this. Imagine that you have Tesla, EEA. Tesla is normally a company that is very hyped. It is always there in the media. We always see cars. It knows how to do its marketing very well. But imagine that her cars are now horrible. They are no longer the main one in the market. Are the cars bad now? They suck. Investors are not going to be so interested in that company's stock. But why? Because the business probably, as their product now is not so good, their profit may also fall. Understand? They're going to sell fewer cars, for example. So people are going to want to get rid of that stock because nobody wants to lose money. Now, if Tesla launches, for example, a revolutionary new product in addition to what it has already launched, and that it is only Tesla that in that product, that technology, people are going to want to be part of that business, and that makes the stock price go up. So, in a nutshell, if a company announces that it has made a big profit, the stock price tends to go up. If a company has announced that it has made a revolutionary discovery, the share price also tends to rise, and also has the expectation of the market. Imagine that a company, even if it has no real product, only has the promise of having that product enter the market. They shares even is they son. in order to obtain the funds and conduct the research, for instance. This innovative product has the potential to revolutionize the market. Investors are inclined to purchase the shares of this company, driven by the fact that the initial price is relatively low, creating a snowball effect. As a result, more people will be tempted to invest in the company's shares. However, it could also turn out to be the opposite scenario. For example, if it was eventually discovered that the promises made by these companies were not feasible, the stock price of the company would dramatically decrease. I'm providing this example because I genuinely want you to comprehend the concept clearly, which are actions. Imagine you bought shares of a technology company for $100. Let's say you are investing in the American market, and a few months later, this company launches a product that is very innovative. So imagine with this, people who were out of the business are going to want to get into that business, and now the stock price is going to get higher. Your investment of 100 USD, for example, will now be worth 150 USD. And you then, do you decide to sell alone? Part of the deal. So imagine, you had a profit of 50 USD. It's pretty simple. You buy part of the business, that business goes well. If you sell, you make a profit. If that business goes badly, if you sell below the price, you're going to lose money. But then, let's talk a little about the benefits you will get if you invest in stocks. The first benefit is certainly the growth of your assets and shares. This is one of the best ways to grow your wealth over the long term. Because even if the stock market fluctuates in the short term, if you take the chart of the largest companies, for example, imagine Coca-Cola, Microsoft, they are always growing. And the stock market as a whole, it always tends to grow in the long run. For its shareholders, this becomes a source of passive income. Additionally, investing in stocks allows you to diversify your assets. What does diversification mean? It means not putting all your money in one place. With a wide range of companies to choose from, you can invest in various sectors such as automobile, construction, and technology. Imagine the possibilities. Find companies there from all sectors. Let me give you an example of a person who started investing from a young age, and today he is one of the richest people in the world. That person's name is Warren Buffett. His strategy was, from a very young age, to buy shares of companies that were undervalued. He waited patiently for their growth. This gentleman here is considered perhaps the greatest investor in history. I'll give you a quick guide so you can start researching and study. Before we commence, fundamentally speaking, it will be studying the concepts. And you also have to invest monthly. You have to make monthly contributions. That's the big secret. Every month you should invest a little and have patience. There is no such thing as getting rich overnight. So today you learned what stocks are, how they work, and why they are an excellent strategy to increase your wealth. I hope you enjoyed the video. If you have any questions, please leave in the comments. I will do all possible to respond. Do you like head? I will do my best to research and respond with the correct answer. And I say again, if you parachuted here, I ask you to watch the past videos on the channel. The idea behind the first videos was to create a financial mindset, and also leave it there in the comments if you already invest, maybe if you are an entrepreneur who has your company on the stock exchange. Thanks for watching and bye.